Hey everyone, this is Ben from Cheddar Flow, and we're back here for a very important video again. I personally believe May will be one of the most volatile months of the year, if not the most volatile month of this entire year of 2022. A lot of charts are finishing up in whatever pattern they are right now, so I'll explain this a little bit later in the video, but basically a lot of these charts, for example, a pennant, are getting close to their breakout level, which would happen at some point in May. So time and price are meeting each other, which means there's going to be a lot more volatility. Things can go a lot of different ways in a very aggressive manners. So what I first want to go over here is the SPY flow. Basically, we're seeing a ton of premium going into these puts end of day on Friday and also throughout the day. So I have it filtered up here for over $500,000 worth of premium. And basically after hours on Friday, we saw a bunch of 390 and 395 puts for the 520 expiration. This is very aggressive. These are far out of the money with tons of premium, well over 10 million, well over 15 million actually of premium for these puts. So that's very bearish, first of all. However, I do want to note something. So if we look through all of the flow from that day, we're seeing a lot of similarities. We see the 398 strike here, another 398 strike with millions of premium all along each of these. Like, look at these. All of these are just really, really bearish. There's a similarity, though, between all of these, and we've been seeing a lot of these prints from this past week. And basically, we're getting near to FOMC, which is on Wednesday of this week. So definitely mark that on your calendars. You're going to want that. And basically, that's going to be a very big event to see how much they actually are rate hiking. Is it going to be hawkish, which as of now, it is pretty hawkish. But how hawkish will it be is the real question. And that's kind of what I want to get at. What's the extent to them doing rate hikes on us right now? Because it still could be a hawkish overall, whatever they choose afterwards. But if it's not to the extent that the market's already priced in, then we could have a rally off of FOMC. And basically, all of these puts are a lot of protection going into that event. So what that means is if we're not surprised by what happens during that event on Wednesday, there's a potential that this thing could actually rally even though the Fed is still hawkish on raising rates. Just because there's so much protection on here, people are going to start to unwind that protection, and we're actually going to see a rally, even though everyone's going to think it's bearish because of what they said. And we've seen a lot of these happen in the past to an extent where the news seems bearish on something. You've probably noticed this pretty often, where the news seems really bearish on something, yet it still goes up in the stock price afterwards. And it's not random. It's just there's a lot of protection going into these major events. So people are kind of unwinding that, and you're seeing major rallies. And basically, on the chart here, I would not be surprised to see a complete retest of my red line I have on here of SPX this week. If we do have a rally off of FOMC, or just if it wants to retest it in general, would not be surprised. This is going to be around like 4,240 roughly this week if we do get a retest of it. Would not be surprised at all of that. Could go higher if it wants to. But we do have to be very careful as long as we're under this red line. So if we retest it and get rejected hard, that's really concerning. There's a potential we could go even further down to like the 3,900 if it does reject off of this. So be careful of that. But as of now, when we are under this line, it is very, very dangerous territory for the market because this line stretches all the way back until, you'll see over here, all the way back until February of 2016. So this line goes across, with act as a support and a resistance for quite a while, and is very significant. And as of now, we are under it for the first time. We closed under it on not only the daily, but also the weekly for the first time. This is going to be something you need to look at because you're in for a lot more risk if you do enter position while under here. You just need to be aware of that. And also, that's kind of why we're seeing a lot of these put hedges and just maybe bearish bets on the market. But again, like I said earlier, with these bets can come the actual opposite outcome eventually if what they want or what their desired outcome is from FOMC. If that doesn't happen, these have to be covered, and you're going to see a big rally, kind of like we saw all the way back here where we had a bunch of green days in a row, a massive rally off of that. So do be careful. You don't want to short in the hole right now, but also you have to be careful to not go long while we're under this because there is even more risk with being under this red line. So you're going to have to look for more confirmation, and that's kind of what I wanted to get at in this first segment of the video. All right, next what I want to talk about is the dark pools on SPY. I want you guys to pay attention to the dark pools this week. We have started to see some accumulation in the dark pools, which can mean that there is a short-term bottom forming on it. And I'll actually go to our dark pool levels here first. Basically, we're starting to see more accumulation down here. We're seeing over 2 billion in premium, over 1 billion in premium, and that's always very good for accumulation around a zone. Also can mean distribution if we did pop up and saw some selling of a sense. So 427.57, we saw 2.4 billion worth of premium. This was most definitely a sell actually up there because it's much higher. If you look at the chart over here, we closed the day at 412 and it was all the way up at 427 where we saw this. However, if we do go back to previous days like April 28th right here, we could actually see 2.9 billion at that 417. So it's still within the range of where we're trading at as long as we can get up above again. If we go back to 427 here, we could see 2.3 billion at 416. So again, we saw 417 has a lot of accumulation, 416 has a lot of accumulation, and we're kind of getting the sense if you're looking through here, we're seeing some good accumulation around that range, and that's a range that we need to note because as long as we can get back over it, the market can continue in a bullish trend. Tuesday, 426 didn't have anything really. 646 is barely anything for accumulation, so really not paying attention to that. And then same thing with Monday, barely anything on there. So we need to pay attention to that 416 and 417 level because that's where we're seeing the majority of the accumulation. Also, we are seeing a lot on the 412 level, which is at 412.07 and 412 flat. We've seen over 1.5 billion worth of actual singular orders in the dark pool, so not signature prints. Remember, signature prints are prints that happen in an overseas exchange for the dark pool, and basically they are allowed to submit those prints up to 24 hours after they occur. That's just the rule that they're allowed. These, however, the singular ones come in right as they hit the tape on the dark pools, and basically we saw 1.5 billion after hours on Friday. So we're seeing some more of that accumulation here. Definitely note that at the 412 level and then the 416 and 417 levels because we're starting to see that bottom kind of forming here, at least for now. So do note these, especially Monday, Tuesday, and Wednesday before FOMC, because that could give us a sense on if we're actually going to bounce around this range. So lastly, I have something very, very important for you, and it is this chart here on SPX. Basically, we were trading within a diamond pattern on SPX all the way since July of last year, so it's been 10 months since then, and the diamond pattern is characteristically bearish on whatever chart it is on, and basically we fell down below this diamond pattern, which is also very bearish. This is typically the start of when we see extended and accelerated selling, which in other words could mean a potential crash in the future. Now, am I saying there's going to be a crash? No, I'm not saying that. Again, we never know with the market. It's all about probability. However, I do caution you, and again, listen up here, I do caution you as long as we are under this diamond. So as of this week, we have FOMC occurring like I shared with you earlier in the video. We could see off of that, and I'm going to give you just my prediction here of a possibility. Remember, it doesn't have to happen, but we could see a potential rally off of FOMC because all of the puts that I was sharing with you earlier in this video have actually provided way too much protection for the market for it actually to continue selling or crash. So we could see a rally up until this blue line that I have right here highlighted, which would be around 4,300, 500, could go even as high as 4,400 as long as the weekly wick actually closes below here. So that is a pretty big pop-up from where we are right now. Again, it doesn't have to happen, but I would caution you from shorting where we are right now because you are shorting in the hole. This is a very risky level to short. We are in a demand zone right here. This is a big demand zone for the market right here, so it'd be really stupid to short here. And knowing the market, it likes to do extremes. So an extreme would be off of FOMC to see all those puts get unwinded and actually have a rally to retest this level up here of our diamond pattern. And then after that, if it can't get above and it can't hold on there, then we start to see that big sell-off potential after. So this is something I want you guys to note because it is very risky to short down here, and there's also potential for a rally again. We know the market likes extremes, like I said, so do be careful of this. Just wanted to share with you this clip here, very important. And otherwise, I appreciate you guys watching this video, and I will see you guys in the Discord and then also in a future video this week.